If you're someone who knows that investing is important but doesn't want to spend hours researching companies and watching the stock market, then the investment I'm sharing today is the ideal investment for you. I'm Sean, a data scientist who teaches personal finance and investing for beginners. Bop the like button and let's dive in. You may have seen my video on the only stock you ever need for your entire life. And really that stock is a broadly diversified index fund containing many different stocks. But what I didn't mention in that video is the addition of bonds as you get closer and closer to retirement. Stocks are shares of company ownership. They are volatile. In the short term, we don't really know what's going to happen, but in the long term, they generally go up. On the other hand, bonds are loans to companies or governments and are much more stable but yield less growth. You can break down your investing life into two parts: wealth accumulation phase and wealth preservation phase. In the wealth accumulation phase, you want to contribute as much money as you possibly can and give it time to eventually grow into a large lump sum of money. In the wealth preservation phase, you are drawing out money from your investments to live. In this portion of your life, because you are drawing from your investments to fuel your lifestyle, it is way more important to not lose money than to try to aggressively make more. This is where bonds come in. As we transition from a wealth accumulation phase to a wealth preservation phase, we add in bonds to combat against stock market dips. Right now, you may have VTI or VTSAX, which is a total US stock market index fund, and as you approach retirement, you might want to buy index funds containing bonds. Selecting the bond index fund and contributing money to it is something we will have to do later in life, or we can take a hands-free approach and invest in a target date fund. A target date fund, otherwise known as a lifestyle fund, is a basket of stocks and bonds designed for investors retiring at a certain date. An example of this is the Vanguard Retirement 2060 Fund, VTTSX, which is a target date fund designed for investors aiming to retire in 2060. I'll talk more about how to find target date funds from Vanguard, Fidelity, and Charles Schwab towards the end of this video. What's powerful about a target date fund is that it handles the stock bond allocation for you. When you initially purchase a target date fund, it'll be more aggressive with a higher percentage of stocks. As the years pass and you get closer and closer to retirement age, the percentage of stocks decrease while the percentage of bonds increase. Eventually, when you retire, you'll have a healthy mix of stocks and bonds, where stocks will be there for growth and bonds will be there for wealth preservation. It is truly a set it and forget it way to invest. All you have to do is buy more of the fund and everything else is taken care of for you. I'm going to reveal exactly what is in a target date fund, and you should subscribe if you want to learn more about investing and achieving financial freedom. I am 24 years old right now, and if I were to retire at the traditional age of 65, then I would choose a 2060 target date fund. If you don't know exactly when you'll be retiring, Vanguard has a fantastic way to choose a target date fund based on when you were born or how old you are. So if you're retiring between 1993 and 1997, you can click on this right here. And this will direct you to the recommended target date fund. So for those in that age range, it is the 2060 fund VTTSX. And if we scroll down, we can see exactly what is in the fund. Within the target date funds are stocks and bond index funds. A target date fund is simply a fund of funds. So here we can see that 54% is the Vanguard Total Stock Market Index Fund, which is essentially the US stock market. 36% is the Vanguard Total International Stock Index Fund, and this is all the international funds outside the United States. There's also about a 10% mix of domestic and international bonds. So with this fund, there's about a 90% stock and 10% bond allocation. Let's actually go back one and take a look at another target date fund for someone who's about to retire in 5 years. So this is a 2025 target date fund, and let's check what is the stock bond allocation. So here we can see that it also has the total stock market and international stock market. And if you combine domestic and international stocks, it makes about 60% of the fund, with the remaining 40% in domestic and international bonds. So there's a 60-40 split. Compared to the previous 2060 target date fund, This fund has a higher percentage of bonds because those people who are going to retire in 5 years are transitioning into the wealth preservation phase, and thus is ideal to have a higher percentage of bonds for stability. Let's go over the pros and cons of a target date fund. Pro number 1, simplicity. A target date fund or a lifecycle fund is entirely designed to set you up for the rest of your life. You don't have to worry about stock bond allocation, exactly what to invest in, because it is all handled for you for a small fee. This is why a target date fund is ideal for people who don't want to spend hours worrying about their investments, but just want everything taken care of for them. Pro number 2, broad diversification. A target date fund contains many different kinds of funds, including total US stock market index fund, bond index funds, and more. This is why it is so powerful, because it automatically diversifies you across many different companies and bonds. It helps investors, especially beginner investors, to make the mistake of investing in only a few select companies. You don't want to have all of your eggs in one basket. Pro 3 is automatic rebalancing. The target date fund will handle the allocations of stocks and bonds for you. It also takes advantage of buying low. So if you have 90% stocks and 10% bonds in your target date fund, when the stock market crashes, you may have 80% stocks and then 20% bonds. In this case, the rebalancing will push your allocation back to 90 and 10, which means you are purchasing stock at a discount. This is all done for you and you don't have to do anything. Target date funds have low costs to them. Considering this is handled for you for the rest of your life, having an expense ratio of less than 0.2% is a steal. Another plus is that it avoids investing extremes. With a target date fund, young investors won't have a large percentage of bonds and will be more aggressive in focusing on growth. On the other hand, investors that are closer to retirement won't have a huge aggressive amount in stocks because they eventually need to pull money from that soon. They should be focusing on wealth preservation. The last pro is that having a target date fund helps you avoid other investing mistakes, such as timing the market. All you have to do is buy more of the fund and it tracks whatever index funds it has within the target date fund. Remember, time in the market beats timing the market. Now, there are a few cons with a target date fund. One criticism on a target date fund is that it doesn't account for risk tolerance for an investor. It serves as a general way to invest based on age and when you plan to retire, and it's generally pretty good. But if you're a new investor with 40 years before you intend to retire, then you might want to have 100% in stocks rather than a 90% 10% stock bond split. With that, there's no flexibility really on what you are investing within a target date fund. The stock bond allocation is split for you. You can't select certain companies you want to invest in, but this really isn't an issue if you want a hands-free approach. Great if you're someone who doesn't want a hands-on approach to investing, not so great if you want more control. Another con is that it might not be aggressive enough. As I said earlier, you might want to be 100% in stocks rather than a 90-10. But one way to get around this is purchasing a target date fund at a later date. So if you plan to retire in 2060, you may want to consider a 2065 or 2070 retirement date fund. Lastly, a target date fund is more expensive than managing the stock bond allocation yourself. If you have VTI or VTSAX in stocks, all you really have to do is purchase a bond index fund later in life. That's it. Although a 0.15 expense ratio for a target date fund doesn't seem that much more than a 0.04% expense ratio for VTI or VTSAX, the expenses do add up and grow exponentially over time. We can't control how the stock market grows, but the one thing we can control are fees, and minimizing that as much as possible is to our benefit. Now, let's look at options for target date funds you could buy. There are three major players when it comes to investing: Vanguard, Fidelity, and Charles Schwab. They each have their own versions of a target date fund with different stock bond allocations between them. We've already taken a peek at Vanguard's 2060 Target Date Fund, VTTSX, and with that fund there is a 0.15% expense ratio. This means you're paying 0.15% every single year for owning this fund, and these fees cover management. There is a minimum investment required of $1,000, so if you don't have $1,000, I recommend you invest that in another broadly diversified index fund such as VTI until you have enough money, and if you would like, invest in this fund. Another version of the 2060 target date fund is offered by Fidelity. And with Fidelity, there is a 0.12 expense ratio, a little bit less than Vanguard's. If we go over to the right over here, we can actually see the asset allocation breakdown of the Lifecycle fund. By combining domestic and international stocks, it has a 90% stock allocation with 10% in bonds and other short-term debt. You may have noticed this graph in the middle here. This is the hypothetical growth of $10,000 if you had invested in 2014. This blue line up top is the S&P 500, which represents the top 500 companies in the United States. And as you can see, investing in the S&P 500 would have yielded you higher returns. This is because the target date fund does include bonds, which doesn't grow nearly as fast as stocks do. Another reason is that the target date fund does have about 37% international stocks. And in the recent decades, the United States has grown tremendously, where the value of United States stocks has increased faster than those from international companies. Let's also take a look at Charles Schwab's version of the 2060 target date fund. Schwab's fund has a gross expense ratio of 0.13% paid every single year. It also shows the S&P 500, the green line up top, has grown faster than the Schwab's 2060 target date fund. If we scroll down, we can see Schwab's stocks allocation broken down in the individual sectors. And if we click view portfolio, we will see the stock bond allocation. If we look here, we can see that there's about 61% in domestic stock and 34% in foreign stock, which means it has about a 95% stock allocation, which is slightly higher than Fidelity and Vanguard's versions of the 2060 target date fund. By being a bit more aggressive, it is setting itself for potentially higher returns over the long run. There isn't a big difference between Vanguard, Fidelity, and Charles Schwab's version of the 2060 target date fund. If you decide to invest in target date funds, choosing either of the three is a fantastic choice. Do you think a target date fund is right for you? Why or why not? Let's continue this conversation, and I will see you all in the comment section below. Peace.